Behavioral finance explores how psychological factors and biases impact investor behavior and market outcomes. Unlike traditional finance, which assumes investors are always rational, behavioral finance acknowledges that emotions and cognitive errors can lead to irrational decisions. Common biases include overconfidence, where investors overestimate their knowledge, and loss aversion, where the fear of losses outweighs the desire for gains. By understanding these biases, investors can make more informed and rational decisions, potentially improving their investment performance. Want to master the psychology of investing? Join the movement. Like, subscribe, and follow the Wealth Pioneer